Okay, let us read this problem. If it is simple enough, then you can try it. Else, I'll give explanation. Let's read the question first. Calculate the NAV of regular income on the basis of Red Bull Mutual Fund. Red Bull Mutual Fund. Yes, Red Bull Mutual Fund. Okay. Uh, Listed shares, cash in hand, bonds and debentures. Of these bonds not listed and not quoted, other fixed interest securities, dividend accrued, amount payable on shares, expenditure accrued, value of listed bonds and debentures on NAV date, rupees in crores. Number of units 30 lakhs. Current realizable value of fixed income security face value 100 is 106.5. Listed shares were purchased when the index was 7,100 and the present index is 9,000. Unlisted bonds and debentures are at cost. Other fixed interest securities are also at cost. Okay, I think it's a very similar one. So give a try for 2 3 minutes. Try to compute. This is not having any mutual funds issued and all, but and this is a typical problem you can expect in exam. Straightforward question, but has come in the exam quite a few times. Okay, is it completed? Can you look at the solution? Just wait for 1 more minute. Okay, fine. So let us look at solution. See if you get approximately around 145.86. Are you able to get? Let me quickly go through it once. Equity shares, cost was 30 crores. When you invest, it was 7,100. Now it is 9,000. So into 9,000 by 7,100. Cash in hand 0.75 as it is. No expense given. Expense in any expense accrued. Expense paid, nothing is given. So 0.75 as it is. Bonds and debenture at cost, X interest. Uh, of these bonds not listed and not quoted, and other fixed income securities. I think this is 1 and 2.5, which is at cost only, 1 and 2.5. And listed debentures, they have given the market value 10. That's what I've taken. Dividend accrued is in assets, expense accrued is liability, amount payable on share is liability. So amount payable on share liability, expense accrued liability, dividend accrued is an asset. Cash in hand given, market value be calculated. So asset value you get minus liabilities. This number of crores. So divide by number of units. So 43.78 crores by 30 lakh units. You get 145.86 rupees per unit basis. They are not asking anything from investor point of view. So answer will be only so much. Okay, hopefully you got it. If not, you can take a quick picture of this and you can verify your answer later. Okay, let's go further. I hope you got this question. A simple problem. A mutual fund had a net asset value of 16 at the beginning of the month, made an income and capital gain distribution of 0.04 and 0.03 respectively per unit during the month. The month ended NAV was 16.08. Calculate monthly and annual rate of return. So they are holding for 1 month. Therefore, it's going to be holding period 1 month, and then we multiply by 12, we get the annualized returns. I hope you got the question. So simple formula we'll write down. First, we'll write down holding period return for 1 month, because this is holded for 1 month. Straightforward formula: P1 minus P0 plus D1 divided by P0 into 100. In this case, dividend, when I mean distributions. D, you don't just take it as dividend, you stand D for distributions. Distributions will have the capital gain distribution also, and will have the dividend distribution also. So both of them will take it together. So P1, NAV at the end of the month, which is 16.08. P0, NAV at the beginning, that is 16, plus distributions. Capital gain distributions also, dividends also, 0.04 plus 0.03, and that is 0.07. Divided by P0, which is 16, into hundreds. This will give us 0.9375%. This is holding period of 1 month return. They asked us annual rate of return, annualized yield, annual return. You can simply multiply it by the holding period. So 0.9375 percentage is for 1 month. How much for 12 months? If holding period was 2 months, divided by 2, multiplied by 12. So this is multiplied by 12, annual returns 11.25% per annum. And here you don't have to talk about any multiplicative model. You don't have to do 1 plus r, 1 plus r to the power of 12, effective rate of return and all. You don't have to worry about it. For mutual funds, we always give an institute solution as a simple interest answers. Let's go with simple interest. Simple multiplied by 12 to convert from month into annual. Annualized return. Some people also refer it as annualized yield. Hope it is done. Oh, next. A small problem again. Let's do it quickly. Mutual fund that had a net asset value of 10 at the beginning of the month made an income and capital gain distribution of 0.05, 0.04 unit respectively during the month. And then ended the month with a net asset value of 10.03, calculate monthly return. Let's do it very fast. The holding period return, that is 1 month only, beginning and end. P1 minus P0 plus D1 divided by P0 into 100. NAV at the end of the month 10.03. NAV at the beginning 10 plus dividend distributed, both capital gain also you take, dividend is also take. 0.05 plus 0.04, that comes to 0.09 divided by 10 into 100. 10.03 minus 10 plus 0.09 divided by 10 into 100. So 1.2%. They have not asked annual return, but in case if they asked, you just have to simply multiply it by 12, divide by 1. This is for 1 month. How much for 12 month? Annualized return, annualized yield, 14.4% per annum. As I told you earlier, you don't have to do any effective rate or compounding effect here. 1 plus r to the power of n and all not required. 1.2% is for 1 month. How much for 12 months? Multiplied by 12. Practically, answer is different. From exam point of view, for mutual funds, they have followed the simple interest approach. Let us also follow the same approach. Done? Let's go further. Okay, next one. NAV of per unit XYZ mutual fund, a close-ended fund is 1/1/2014 was 28. Next problem only. Sorry, next problem only. The value on 31st December 2014 comes to 28.8. On the same date, unit was trading in market at premium of 3% through on 1/1/2014. Same was trading at discount at 5%. On 31st December 2014, XYZ distributed a sum of 2.8 as income and capital gains. You're required to compute rate of return to the investor during the year. So this is a close-ended fund. So what do you mean by open-ended fund and closed-ended fund? Normally, when we mean mutual funds, we only talk about close-ended funds. 99% of the mutual fund is only open-ended funds. 99% of the mutual funds, when we say, it is only open-ended, and actually it's implied. But let me tell you the difference. A theory question also may come. So when you invest in the mutual funds, you give money to them, they'll give units to you. So when you want the money, you give the units back to them and they will give the money to you. So when you get the units, it's called as issue of units to you. And when you want the money, you give the units back. That is called as redemption of units. So as you can see in these transactions, investor is transacting with mutual funds for issue also, redemption also. But in shares, do you know what happens? Apart from IPOs, when you buy the shares, you don't buy the shares from company. You buy the shares from another shareholder. And when you sell it to the other person. You don't give it back to the company. That's called a secondary market. IPO is called as primary market. So mutual funds are always primary market. In the sense, you always give the money to mutual funds. They will give it to you. That is open-ended funds. They are not traded anywhere. They will not have price. But closed-ended funds are like shares. Mutual funds will issue the units to you initially, and later if you want to sell, you don't give back to the mutual funds. You will sell it to other person becomes unit holder. So basically those units are traded. Normally mutual funds are not traded. They will not have price. They will have only NAV. But here closed-ended funds, in addition to NAV, they will have price. Because when you transact with the mutual funds, NAV is relevant. But if you're selling in the market to another person, price becomes relevant. And closed-ended funds will have price and NAV, but open-ended funds will have only NAV, will not have price, because open-ended funds are not traded. Hope you got the meaning. So here they are giving data about closed-ended funds. Okay, I think it was next that problem. I hope you got this question right. Yes. Okay. Fine. Fine. So one or two questions can be here and there. Okay. So what is here P1 and what is P0? P1 or P0 first. NAV was 28 and on the date year end NAV is 28.8. This is NAV values, but we cannot calculate from NAV values. We have to calculate from price point of view. So price point, please observe, on 1/1/2014 it was trading at a discount of 5%. Discount of 5% means actual market price will be NAV into 95%, because 5% discount, no? So remaining 95%. On 31st December, it was trading at a premium of 3%. So 28 multiplied by 103%, 3% extra premium. So on the NAV, you multiplied by these percentages, that is subtract discount, add premium, you get the price. 28.8 into 0.95, 27.36, and 28 into 103%, 28.84. Then calculation is straightforward. The return P1 minus P0 plus any distribution divided by P0 into 100. P1 27.36. Actually slightly different, no? Am I making a mistake here? 28 was P0, 28.1, 5% on first. Oh, okay. I think I made a mistake here. This 95 and this should be interchanged. I think I got confused. This discount of 5% is applicable on 5% discount is applicable on opening balance. So P0 should be 95% and the closing balance premium of 3%. So on P1, I was supposed to multiply it by 103%. I interchanged. So this one common mistake which can happen. Be careful in exams. Hope you understand what mistake I have done. You should not do this kind of mistakes. Be very careful. So 28.8 into 103%, 29.66 I think. 29.66. Just 1 second. Okay, so 28 into 95%, 26.6. Okay, so this calculation is going to be 29.66 minus 26.6 divided by 26.6. Of course, you have distribution also, distribution of 2.8 multiplied by 100. 29.66 minus 26.6 plus 2.8 by 26.6 into 100. 22.03%. Okay. Now this one is holding period return as well as the annual return because the data are 1st of Jan and 31st of December. So holding period is also 1 year. Annualized also is 1 year only. So no need to do any further adjustments. So that's all answer for this problem. Let's move on. Okay, I hope you got the next question. This one, small one, but interesting one. Mr. X earns 10% investments in equity shares. So he is a present investor. He is investing himself. He is getting 10% per annum. He is considering in a recently floated scheme of a mutual fund where initial expenses are 6% and annual recurring expenses are expected to be 2%. How much the mutual fund scheme should earn to provide a return of 10% to Mr. X? Understand the problem carefully. Mr. X, you are having as an investor and you are having mutual funds. And mutual fund will invest in the stock market. You understand the amount? X will invest in mutual funds and mutual funds will invest in market. Mr. X is already earning 10% return on his own without coming to mutual funds. So if he comes to mutual funds, at least he should get 10%. That's what we say opportunity cost, his expected rate of return, and his expected rate of return becomes the required rate of return, or that is the return mutual fund must provide. Otherwise, Mr. X will not come. So mutual fund should provide how much return to Mr. X? They should provide a 10%. But to give them 10%, how much does mutual fund should earn from the market? That is the requirement of the problem. I hope you understood the requirement. The mutual fund should earn from the market how much? so that they can give 10% to Mr. X. Very simple, sir. Mutual fund earns 10%, give it to them 10%. That is not right. Why? Because there are some recurring expenses 2%. So if mutual fund earns 10%, then 2% you have to pay. That means the net amount becomes only 8%. Okay. Then 2% also should be earned by the mutual funds. So it will be 10 plus 2, 12% return they should earn. Okay. Now the 10 plus 2, 12% is also not correct. Why? Because there is some initial expense called as 6%, which means if 100 rupee is given by Mr. X to mutual funds, entire 100 rupee will not be generated. How much return? They will invest out of 100 rupees, 6 rupees will be taken out. So if X gives 100 rupees to the mutual funds, mutual fund will invest, they deduct 6 rupees initial expenses and they will invest only 94 in the market. Now on 94, how much amount they have to generate? They should earn 10 rupees, right? On 94, if you earn 10 rupees, then you can give it back to the investor. But percentage terms will be how much? 10 rupees that you have to generate divided by 94 rupees. I hope you understand how it is 94 rupees coming. 10 by 94 into 100. Express it in percentage terms. For the time being, I'm ignoring recurring expense. I'll come to recurring expense also. 10 divided by 94 into 100, you get 10.64%. 10.64%. So if you earn 10.64% on what number? 10.64 on 94. Correct? 10.64% on 94. How much you get? 10.64% into 94, you get 10 rupees. That 10 rupee, you can give it to the investor. Okay, now coming to the recurring expense. 10.64% if you earn, then 2% will go out. You effectively earn only 8.64%. Then this is not sufficient. You have to add even the recurring expense, that is 2%. So you have to generate 12.64%. So if you earn 12.64%, 2% goes for expenses, remaining you will have 10.64%. 10.64% you apply it on 94, you get 10 rupee, which will justify the return for investor. This is concept. Instead of this conceptually, hope you understood, but direct formula is there. Let's apply that formula. Will be faster in calculation. So return to be earned or to be generated by mutual fund is return expected by investor, return expected by investor divided by 100 minus net proceeds, 100 minus net proceeds plus recurring expense. Numerator, return expected by investor divided by 100 minus net proceeds. 100 minus net proceeds, I'm sorry, 100 minus issue expense, I'm sorry. 100 minus issue expenses. That will give you net proceeds. 100 minus issue expense, initial expense. 100 minus initial expense. Plus recurring expenses. The return required by the investor is 10 divided by 100 minus initial expense, 100 minus uh, 6 rupees, okay, into 100. You can just do express in percentage, you can do into 100. Or let's do one thing, let's do 1 minus initial expense, that is also fine. You can do 1 minus initial expense, then you can add recurring expense. So 1 minus initial expense is 6%, so 0.04 plus recurring expense, and that is 2%. Initial expense is 6% plus recurring expense 2%. So 10 by 1.06. So if you simplify, you get, I think, 12.64% only. You can check it out. And verification, in 12.64%, you take out. Okay, I'll show you verification also quickly, just for your verification purpose. How much return he has generated. Verification not required for exam. I'll just do it for your reference. I hope you have done till here. Okay, so I'll take this part out. I'll erase this part. Now after erasing, don't ask me to go back. I cannot do Control Z here. Okay, I'm deleting. Okay, verification. Okay, let's say Mr. X has given to mutual fund rupees 20,000, just for example purpose. 20,000. So how much mutual fund would have actually invested in the markets? 20,000 minus expenses, initial expenses 6%. So if I subtract 6%, that is 1,200. If I subtract, they have invested only 18,800. That they have invested. Now on 18,800 that they have invested, how much is the return they have got it back? We just calculated at 12.64%, right? So 18,800 into 12.64%. 2376. 12.64 only, right? That number? 12.64 only, okay. So 2376. 2376 approximately. And this will not go entirely to him because recurring expenses are there. So you subtract expense. Expense is at 2%. So 2% on 18,800. On 18,800, 2% if you apply, 376. So what is the net amount that comes is 2,000. So what is given by the mutual fund back to the Mr. X is 2,000. So what is his return? 2,000 out of 20,000. So return for X is going to be 2,000 divided by 20,000 into 100, and that is 10%. Or you can also say P1 minus P0. What is P1? NAV at the end of the month, 18,800 they have invested. They generated 2376 minus 376 expense. If you go, you get the balance amount. I think how much you get? 18,800 you invested. 2376 comes minus 376. 20,800, something like that, maybe. Anyway, so 20,000 is what invested by Mr. X. 2,000 is his return. 10% he's got. So what return he has got, we could verify through numbers. Okay. I hope you got this one. Verification not required for exam. I just did for your reference. Let's go further. Okay, let's go further. This problem, hope you got it. This is again a repeatedly asked question. Simple tabular format about calculation of return only, nothing else. Just about return calculation. Some table they have given. Basic structure will remain same. What is basic structure? P1 minus P0 by P0 into 100. That formula will remain same. Let's try to calculate. I'll also show you how institute usually shows the solution. Let's also do it independently. Mr. A has invested in 3 mutual funds as per details below. 1 2015, 1 2016, 1st of March 2016. Amount of investment 1 lakh, 2 lakh, 2 lakh. NAV at entry date. Dividend received up to 31st March. NAV on year end. Assume 1 year, 365 days. Show the amount of rupees up to 3 decimal points. You're required to find out the effective yield on per annum basis. Effective yield means what? Annualized yield per annum basis in respect of the above 3 mutual funds up to 31st March 2016. Okay, let's calculate. I'll also show you how the institute has shown a solution. 3 columns required, ABC, no connection between them. It's like solving 3 problems only separately. Basic formula, you know, anyway, let's write it. ABC, 3 mutual funds. We require basically 3 things. We require a P1, we require a P0, and we require dividends. D1 you can say. Now P0, what is the investment? Amount of investment 1 lakh, 2 lakh, 2 lakh. So 1 lakh, 2 lakh, 2 lakh. Okay. Now what is dividend 1? That is also given. 2850, 4500, 0. 2850, 4500, 0. We need P1. P1 how much? They are given, sir. P1 at the end of the 10.25 or 10.15, 10. Don't take that numbers. Why you should not take that? Because these numbers are total basis. You can calculate either in total basis or you can do per unit basis. Don't mix the both. Here I'm choosing total basis. Why I'm choosing total basis? Because the value at the beginning I know, total investment. Dividend I know, total dividends. Since those two are in totals, let me do everything in total basis. But P1 they have not given total. P1 they have given per unit. Convert. Or you do what? P0 you convert it into per unit basis. Dividend you convert it into per unit basis. Ultimately answer is going to be same mathematically. I hope you understand. Let's calculate P1. How do you calculate P1? What is the value of investment at the end of the year? Simple concept. 1 lakh you have invested. When? At NAV of 10.3. So how many units you would have got? 1 lakh divided by 10.3. And at the end of the year, NAV became 10.25. So 1 lakh divided by 10.3 will give you number of units. Multiplied by 10.25 will give you the closing value. So let's calculate here. 1 lakh divided by 10.25 multiplied by, whatever number of units. Remember, units can be fraction. Shares cannot be fraction. Units can be fractions. So if I do 1 lakh by 10.25, 9756.10. 9756.10 multiplied by year end NAV. Oh, sorry, 10.3, not 10.25. It was 10.3 when you invested. So 1 lakh divided by 10.3, 9708.74 units. 9708.74 and NAV at the end was 10.25. So multiplied by 10.25. 9708.34 into 10.25, 99,510. I think that is said effective yield 3 decimal points. Effective yield, that 3 decimal you can take at the end. Now we'll take 2 decimals. 99,510.48. 99,510.48. Okay. Let me come to similarly for B. You invested 2 lakh, NAV was 10 rupees. So 2 lakh divided by 10, that is 20,000 units multiplied by, at the end NAV is 10.15. So this will be 20,000 into 10.15, 2 lakh 3,000. Similarly, for last one, NAV was 10.1. So 2 lakh divided by 10.1, 19,801.98. 19,801.98 multiplied by NAV at the end, that is 10 rupee. 1 lakh 98,000, 19,801.98 into 10. Okay, now 1 lakh 98,020, rounding it off. 1 lakh 98,000, 19.8. Okay, 1 lakh 98,000, 19.8. Okay, and then what is going to be the holding period? Return, if you calculate, you know the formula. P1 minus P0 plus D1 divided by P0. They've asked annual return. So what do? You multiply it by 12 and divide by number of months. Like this is for 1 month, how much for 12 months? So into 12 divided by n. P1 is 99,510.48 minus P0 1 lakh plus dividend 2850 divided by 1 lakh into 100. 99,510.48 minus 1 lakh, sorry, into what is the holding period? That also we should do. From 1st of November till 31st of March. So November, December, Jan, Feb, March. 5 months. So into 12 by 5. Don't do 5 by 12. Reverse, reciprocal. This is for 5 months. How much for 12 months? So into 12 by 5. So 99,510.48 minus 1 lakh plus 2850 divided by 1 lakh into 100 into 12 by 5. 5.665%, I think, per annum. Okay, hope you got 5.665. Similarly, let's do for second one. I'll write it here. NAV at the end was 2 lakh 3,000. So 2 lakh 3,000 minus 2 lakh plus 4,500 divided by 2 lakh into 100 divided by what is the number of months here? February. So February, March, 2 months only. So into 12 by 2. 2 lakh 3,000 minus 2 lakh plus 4,500 by 2 lakh into 100 into 12 by 2. 22.5%. Okay. Last one you calculate. quickly. I'll do direct calculation. Hope you understand. 2 lakh was the investment. 2 lakh was investment. So 1 lakh 98,000 19.8 minus 2 lakh divided by 2 lakh. No dividends into 100. Then this is only for 1 month. So into 12 by 1. I think minus something you get minus 11.88. Minus 11.88%. Simple calculation, nothing complicated. Just 3 schemes are there, nothing beyond that. Okay, fine. I'll just show you institute solution also. They've done slightly differently. I'll tell you what is that. I'll just show you this is the institute solution table, investments, opening NAV. They got number of units, just like the way we got. They multiplied by NAV. They got the closing investment, just like what we got. Then they found out P1 minus P0. That's what they said, increase or decrease in NAV. Dividend received they've taken. Then total yield, nothing but P1 minus P0 plus D1, which is what they've done. This is the small difference they've done. They have taken on number of days basis. We have taken number of months, right? They have taken number of days. See, we have what we have done. November you purchase. So November, December, Jan, Feb. So 4 months you have taken. Uh, uh, December, November, December. Okay, 5 months. 5 months we have taken. 5 or 4. 5 months. So 5 months, but they have done number of days. They counted November how many days, December how many days, like that, and that is why they got 152 days. So what we did into 12 by n. 12 divided by number of months. They did 365 by number of days. The same formula they also got it. So that's why you see some small differences coming decimals. But in the question they are not specified whether you should take days or not. But one thing you observe, they said assume 1 year equal to 365 days. Did you observe that point? Since they have given 1 year equal to 365 days, it's better than our solution to go with institute solution. I have done so that you understand the calculation process. I hope you got it. But in examination, I would not recommend to go for this problem number of months. I would recommend you to go just like the way institute has done it. That is 152 days, 60 days, 31 days. I hope you know how to count. Like number of days, January 31, February 28, March 31, like that. They have counted number of days. So instead of 12 by n, they did 365 by number of days. They got slightly different numbers. If you want, you can make a note of it. 5.678, 22.813, and last one, minus 11.657. Minus 11.657. Minus 11.657. Anyway, in the exam, I also would recommend you, if they're given you like the information, 1 year equal to 365 days, that indirectly means count the number of days. And there also one point kept in mind, two difference of opinion exist. See, for example, on 1st of March 2016, we took 1 month. If it is number of days, how many days will you take? Normally, we say, will not count 1st of March, we'll take it 30 days. Normally, we take that. But if you purchase at the beginning of 1st of March on morning, that means 1st of March also will be counted. If you invest at the beginning, morning on 1st of March, then 1st of March also will be included. Then 31 days will come. Institute has taken 31 days. Means institute while solving, they have assumed date of investment also to be part of number of days. There also small difference of opinion exists, but you can write your assumption. Either ways, if you use like that 31 days, then you write an assumption. Even the date of purchase also counted. If you assume other way around, you say that date of purchase is not included in number of days. Whichever your assumption, make your assumption clear. I just want to make sure that you understand the institute solution also. Hope it is done. Let's go forward. This is also computation of NAV returns, but with little bit of complications. This mutual fund chapter, let me tell you, is all about NAV and NAV returns from the investor point of view or mutual fund point of view. All problems are revolving around that. Or worst case, they can ask you ratio, the Sharpe ratio, trainer ratio, which we'll see in other problems. I would have done already in portfolio management also. Anyway, so let's do this problem, then we'll hear about others. A mutual fund company introduces two schemes, dividend plan and bonus plan. The face value of the unit is 10. On 1/4/2005, Mr. K invested rupees 2 lakh each in plan D and plan B, when the NAV was 38.2 and 35.6 respectively. Both the plans matured on 31st March 2010. Particulars of dividend and bonus declared over the period as follows. What is the effective yield per annum in respect of two plans? Ultimately, same answer, same question. Compute the yield for A separately, for B separately. Okay, let's understand dividend plan and let's understand bonus plan. Now, dividend percentage. Now, please tell me in this case, either in plan D or plan B, dividend or bonus plan, will the number of units remain same at the beginning of investment and at the end of investment? Do you think it remains same or it will change? Number of units. Number of units will change for the reason you receive dividend and dividends will be reinvested. You receive bonus shares, bonus units, number of units will change. So in both the cases, dividends you receive, you reinvest. Sir, where it is given, that is implied. Then I mean, if nothing is given, we usually assume that the dividend is reinvested. So when you reinvest dividend, you get more number of units. Bonus units also you get. So in both the cases, you will have more number of units. So when we say more units, what do you mean by that? Uh, you should not calculate return on per unit basis. You should calculate return only on total value basis. Total investment minus beginning investment divided by beginning investment into 100. It should be on total basis, cannot be on per unit basis. Anyway, that will come to the last. In some problem, they'll complicate further. They will say capital gains are taxed at 10%. No, education says short-term capital gain is so much, long-term capital gain is so much. That kind of complexities are not here, so you don't worry about it. Okay, let's focus on dividend plan. Okay, dividend plan. Okay, I should explain the ratio first. What is this 0:1:0.5? That is 1:5. 0, I mean, I think number is not printed correctly. I think it should be. I think in the formatting it has changed. Okay, this you please understand as 1:5. 0:1:0.5 means please understand as 1:5. Okay, that's a typing mistake from my side. In the exam, this will not happen. This you treat as 1:8, and this you treat as 1:10. Just correct it. Just give me a second in my material also. Last one is 1 is to 10. Yeah, 1 is to 10, correct. So, what is this dividend 10% means? 10% of dividend on what? Can you tell me? 10% dividend is percentage. How do you get the amount of dividend? 10% on what? 10% on face value. So 10% on face value, you understand. 10% on 10 rupees, 1 rupee. But into number of units, which will change every time, keep it in mind. Then come to bonus ratio. 1 is to 5 means what? 1 bonus for every 5 units held. If you have 5 units, you get 1. That is bonus. Okay, let's calculate first dividend plan. So let's follow a simple tabular approach. Like, let's have various dates, dividend receipts, dividend reinvested, means you get this is the number of units obtained. When you reinvest dividend, you get number of units, and cumulative total number of units, total number of units as on particular date. So number of units dividend reinvested means that is how much dividend received and reinvested. You will have some units, and when you add number of units, that will become total. Okay, let me just start with initial dates. The date given on 1/4/2005, 1/4/2005. Amount of investment, 2 lakh, and invested in face value of 10 rupee. No, not 10 rupee. Not 10 rupee. NAV was 30.2. So how many number of units? Initial 2 lakh divided by 38.2. Not 10. If it is issued at further offer NFO or like IPO, then you take 10 rupees. But NAV 38.2. So you got 5235.06 or 5235.60. Please take two decimals. Units can be fractional. 5235.60. Okay, so this is the initial part, initial investment. So that's why other things are blank. Then dates. Dividend dates are 4 dates. 30th September 2005, 31st March 2007, 15th September 2008, then 27 March 2009. Okay, so write down the dates. Okay, how much dividend received on the first day? You are received 10%. 10% on what? Face value. 10% on 10 rupees. So 1 rupee. So you are having 5235.6 units into 1 rupee, which is 5235.6. Okay. Now, can you tell me how many units you get by reinvesting this dividend? How do you calculate? This is the amount received by dividends. This will be reinvested, implied. When nothing is given the problem, it's implied from exam point of view. Practically different. This is the amount you have. But how do you calculate number of units received? This will be divided by NAV. Correct? NAV on this date. NAV on 30th September. NAV on 30th September, plan D is 39.1. So divide by 39.1. I hope you're able to calculate this. 5235.6 by 39.1. 133.90 units. So what will be total number of units? You already had 5235.6 plus 133.9, 5369.5. 5369.5. I hope you are able to calculate this. Like that, can you try for remaining 3 days? I'll give you the final number after this. Can you try? If you have any doubts in this process, you can ask. Do one calculation correct. Once you understand one calculation, remaining is very simple. Number of units into dividend, you get dividend amount, divide by NAV on that date, number of units. Add it, you get the last column. Multiplied by dividend. Again, same process. So, any doubts you get clarified? And you try for remaining 3 days. I'll give the numbers after 2 minutes. Okay. If you have done, please check it. Ultimately, number of units, what you should get is this. That's our requirement. Because to compute the yield, I need to know the amount at the end, for which I need to know the number of units. For the number of units, we are preparing this table. See if you are able to get that number, 5915.92. I hope you are able to calculate. If not, you can take down the numbers and you can verify it later. Okay. Did you get it? 5915.92. Any other number? Any doubts? Okay. So I hope you got it. Let's calculate the holding period return. Holding period return. Investment at the end. How much will be investment at the end? 5915.92 multiplied by P1. What is the price NAV at the end? Last date 40.4. That's the date we have, 31st March 2010. 40.4 into 40.4. How much you get? 2,39,000, 3.16817. 2,39,000, 3. Let's round it off. 2,39,003. This is value of investment at the end. How much you have invested minus 2 lakh divided by investment 2 lakh into 100 to express in percentage. So the holding period return you get 19.50%. 19.50. Now this is holding period for how many years? From 1/4/2005 till 31/3/2010. So it is for how many years? 6, 7, 8, 9, 10, 5 years. So we will do divide by 5. Or if you do into 1 by 5, you get annual yield. Holding period is 5 years. So annualized yield 19.5 into 1 by 5 divided by 5, 3.9. Annualized yield 3.9. Okay. Let's go for bonus plan. Similarly, bonus plan. Same thing we will have it. Dividend not required because we don't have to calculate NAV and all. Dividend not required. We require only number of units. So let's say dates, whatever bonus units received, and total units. So on 1/4/2005, what is the initial amount? Initial units. Amount of investment is 2 lakh and NAV was 35.6. 2 lakh by 35.6. 5617.98. 5617.98. Now next year, what are the bonus dates? Let's write down. 3 bonus dates: 30th June 2006, 30th June 2006, 27th March 2000, 30th October 2008, 30th October 2008, 31st March, no, 11th April 2009. 11th April 2009. Ratio also will quickly write down. 1:5, 1:8, 1:10. So 1 by 5, 1 by 8, 1 by 10. This should apply to number of units. So 5617.98 into 1 by 5 will give us to 1 by 5. 1123.59. Okay, 1123.60. Add it. 1123.6 plus 5617.98. You get 6741.58. Then this into 1 by 8. 6741.58. 6741.58 into 1 by 8. 842.70. 6741.58 plus 842.7, 7584.28. 7584.28. Then this into 1 by 10. 7524.28 into 1 by 10. What for every 10? 758.43 plus 7584.28. You get 8342.71. 8342.71. So ultimately, this is the number of units at the end. So let's calculate then. Holding period returns. You know how to calculate. P1 minus P0, a total amount basis. So 8342.71. We multiplied by NAV at the end. NAV at the end, 39.7. 3,31,206. 205.6, rounding it up, 3,31,206 minus investment 2 lakh divided by investment 2 lakh into 100. 3,31,206 minus 2 lakh divided by 2 lakh into 100. 65.60%. Annualized yield divided by 5. This is percentage. Annualized yield, annualized return. 65.6 into 1 by 5. 13.12%. 13.12% per annum. So that's it. Looks big one, mechanical one, I would say. Okay, let's go further then. Okay, next. Hope you got this one. This is also about NAV calculation. NAV reverse calculation. Mutual funds cannot go outside NAV. You understand how important this term is. So institute is bored of asking you compute NAV from based on our computer returns. Now in this problem, reverse. They will give you returns. You have to calculate NAV back. Interesting? Let's solve this. And you see again, question, similar question like this also asked many times. Mr. X on 1/7/2007, during the initial offer of some mutual fund, invested in rupees 10,000 units, having face value of rupees 10 each. I hope you got the question first of all. Okay. On 1/7/2007, during the initial offer, some mutual fund was invested in 10,000 units having face value of 10 each. On 31/3/2008, the dividend operated by the mutual fund was, dividend operated, I think dividend distributed, given, was 10%. And when nothing is specified, I told you, this dividend is assumed to be reinvested. Mind it, when nothing is specified, we always assume from exam point of view, the dividend is reinvested. Mr. X found that his annualized yield was 153.33%. On 31 December 2009, 20% dividend was given. On 31/3/2010, Mr. X redeemed all his balance of 11,296.11 units when his annualized yield was 73.52%. What are NAVs on 31/3/2008, 2009, 2010? Okay. One more hint you have. When you invested, you have 10,000 units. But when you redeem, you have 11,296. How 10,000 became 11,296? Where do you think additional units have been obtained? Where do you think we got the additional units? That is from dividend reinvestment. So that is also a kind of confirmation that the dividend is reinvested. Okay. And one more point, I don't know whether I told you earlier. We use the formula, right? P1 minus P0 plus D1 divided by P0 into 100. When you use that formula, if dividends are reinvested, then don't take again D1 here. You get my point? When you do the P1, you do on total basis. So you do total number of units into NAV on that day. That includes dividend reinvestment also. So don't take P1 and D1. That will be duplication. In other words, if dividend is reinvested, in that case, when you calculate on a total basis, per unit basis, okay. When you calculate on a total basis, don't again take dividend. I've done already in earlier problems, but I just want to confirm it here. Okay, let's understand in this problem what is happening. He started on 1/7/2007. So 1/7/2007. That is his starting point. He redeemed on last date, that is on 31/3/2010. In between, two dates comes. 31/3/2008 and one more year end comes 31/3/2009. Right? Now on 1/7/2007, NAV is clearly given. NAV is clearly given 10 rupee per unit. NAV 10 rupees. NAV on 31st March 2008, we don't know. We have to calculate. NAV on 31st March 2009, we don't know. We have to calculate. NAV on 31st March 2010, we don't know. We have to calculate. Hope you got the requirement. Let's plot. What else information available? Number of units information available. Number of units. Okay, let me write number of units. How much number of units? 10 rupee. Okay, 10 rupees the face value. Huh, 10 rupees the face value. You are right. But we don't have any other information, right, on that day? On 1/7/2007, we don't have any other information. We don't have at least amount of investment. If I know amount of investment, amount divided by number of units, I could have got NAV. But no information is given. So I'll have to assume face value NAV both are same because no other realistic assumptions possible. So number of units 10,000. Value of investment you can say NAV into number of units if you want. Okay. Let's focus now. What are the other information available? Let's take up one by one. Okay, number of units at the end also available. Okay, number of units at the end. Number of units. How much number of units at the end? 11,296.11. So when you started, you had 10,000, but when you finished, 11,296. That is because on 2 times you have received a dividend and you have reinvested. 2 times. On 2008, you received dividend, reinvested. 2009, received dividend, reinvested. Do we have information on dividends? Let's see. Dividends, 10% was given, right? 10%. Dividend, 10%. And on 2009 also, dividends, 20%. No dividend on 2010, so you ignore it. Now 10% on what? 10% on face value. We know face value. Face value is 10 rupees. I mean face value 10 rupees. So can I say 1 per unit then? 10% on 10 and 20% on 10. 10% on 10, 1 per unit. 20% on 10 is 2 per unit. I hope you understand the process in which we are solving the problem. We are just writing whatever the data it is, what we have to calculate, and whatever data we have given, they have given, we are writing on a columnar basis. I mean, data wise, we are writing. When we are not calculating anything great. Whatever data given, we are trying to write in a structural format. That is the important process, my dear friends. Not only for this chapter, any chapter. When you look at a problem, can I tabulate? Can I structurally present? If you can present it structurally, that means you understand the thing systematically. Not only here, I would have told you earlier, while solving a problem, anything in life, be it personal, financial, or your career wise, you have to think structurally. What is the problem? Define it structurally stepwise, then look at alternate solutions, choose the correct one. Systematic approach. So data is given in the form of sentences. We are trying to write in the form of table. We like tables. Financial managing people like tabular presentation. Anyway, so that's what you would see in all my chapters. To the extent possible, my answer will be tabulated so that it's clearly demarked rather than writing full sentences. You also try to think in those lines. Okay, lot of philosophy and will not work. Let's continue. Okay, what else data is given? Dividend per unit they have given. What is the next logical thinking? You see how systematically we are thinking. Dividend percentage they have given. I multiplied by face value. I got dividend per unit. What is the next logical thing? If I extend this further, from the percentage, I multiplied by face value, I got per unit. What is the next thing which comes obviously? Total dividend, I'll have to multiply it by number of units. Very simple logic, right? For you to think, you need to multiply it by number of units. Now, number of units do I know? Can I calculate number of units? Number of units was 10,000. Can I multiply it by 1 per unit? The answer is yes. For the first year, I can calculate. For the first year, I can calculate, right? 10,000 on that only I receive dividend. 1 per unit. Why are you thinking no? But second year, I cannot use it. This 2 rupees, I cannot use it. Hope you understand what can be used, what cannot be used. First year, 10,000 units into 1 rupees, that is 10,000 rupees multiplied by 10,000. Second year, I cannot calculate. Second year, I cannot calculate. Okay, now let's first address the first year thing. Now, first year, what and all information I have? Our investment value, total value, 10,000 units of 10 rupees, 1 lakh. 10,000 rupees of 10 each, 1 lakh. Okay, now year 1, 31st March 2008. Is there any other data available? Yeah, this is 10,000 is given reinvested. Absolutely correct. 10,000 is given reinvested. But any other information available with respect to 31st March 2008? We have. That is annualized yield. 31/3/2008. Dividend is given at 10%. Sorry. Annualized yield is 153.33%. Okay. I'll go to next slide and write that information. Otherwise, too much will become one place. That requires the calculation. Simple formula. Hope you have done till here. I'll go further. Okay. So on 31st March 2008, what they have given? Annualized yield, which is calculated by, I'm doing a total basis, total investment. You can do per unit also, but I'm doing a total basis. Uh, Value of investment at the year end minus value of investment at the beginning. Divided by value of investment at the beginning into 100. I hope you understand why I'm not writing dividend, because dividend would be reinvested for that reason. Annualized yield is given as 153.33%. Of course, into 12 by number of months also you should do to express in annual terms. So annualized yield 153.33. Value at the end of the year we don't know. Should I require so much? Okay, this formula is there. Okay, I think so much not required. I'll try to do it very simply, my dear friends. I don't know why. I edit slightly longer. You can use this formula, simplify, longer process. What is your initial investment? Your investment is 1 lakh. What is the return obtained? 153.33%. So can I calculate like this, my dear friends? 1 lakh into 153.33%. This is per annum. But what is your holding period? From July to March, 9 months into 9 by 12. So how much return you get? 1 lakh into 153.33% into 9 by 12. Uh, 1,14,997 is it approximately? 998. 1,14,998. So total investment at the end, 2,14,997. 998. Okay. Now investment at the end, 2,14,998. Now this I should divide by number of units, or this return includes the dividend elements. This return includes dividend element, or this value of investment includes dividend. If I subtract dividend, because I'll repeat this point, some people might have this doubt. I would have told you earlier, when you pay dividend, what will happen to the NAV? When you pay dividend, NAV will come down. NAV will reduce when the mutual funds pay. That's called as ex-dividend NAV, right? We need NAV after paying dividend. This amount includes dividend, but we don't want to include dividend. So I should subtract. So minus dividend receipt, and that is 10,000 something, I think, 10,000. 1,14,998. Okay. Divide by number of units. 10,000 units. So NAV you get 114.998. Okay, 10,000. Okay, fine. Sorry, I subtracted the 1 lakh. Sorry, okay, I subtracted 1 lakh. So you get 2 lakh 4,000 something, right? 2 lakh 4,000. 2 lakh 4,998. You should divide by 2 lakh 4,000. Okay, round it off. 2 lakh 4,998 divided by 10,000. Uh, how much you get? 20.4998. Yes. So 20.50, I can say round it off. 20.50. Dividend paid to investor, definitely. Mutual fund is paying the dividend to investors. This is the calculation from investor point of view. So dividend received by investor only. Hope you got 20.5 NAV. Okay. So I'll go back. So NAV, what we are supposed to calculate, we did 20.5. 20.5. Okay. 20.5. Okay. Now when I know 20.5, we can calculate number of units now. Okay, I'll just write it fresh in a separate thing. But I hope you written till here first. Okay. So next I'll write 31st of March 2019. Number of units. What was the number of units on 17 2017. 17 2017 was 10,000 units. And how many units you would have purchased now? Units purchased on, or units dividend reinvested. Units through dividend reinvestment on 31 3 2018. You received a dividend of 10,000 and NAV was 20.5. So number of units would be 10,000 by 20.5, 487.80. So as on this date, units on 31 3 2019, just before dividend investment, before dividend reinvestment, is 10,487.80. Hope it is fine. On 31 3 2018, I received a dividend of 10,000 rupees. On that day, my NAV was 20.5. So 10,000 by 20.5, I would have received 487 units. Previous year, 2018. So total units on 31 3 2019, just before dividend, would be 10,487.80. Okay. And what is the units on 31 3 2019 after dividend reinvestment? Do you know this number? How many units I had on 31 3 2019 after dividend reinvestments? We know the number. We know the number. 11,296. How do I know that 11,296? Because on 31 3 2010, I did not receive any dividend, which means this number of units must be there with me on 31 3 2009 only. In the sense, what I'm trying to tell you is very simple approach. So I'll tell you one more method also, logical one. First, you calculate this 11,296.11. So how much should have been units obtained through dividend reinvestment? Units obtained through reinvestment, dividend reinvestment on this date. Balancing figure 11,296.11 minus 10,487.8. 808.31. 808.31. Okay, very good. Okay, so what I've just calculated now, I will just show it once more in a slightly different way. Okay, let me try to give everything from a fresh perspective. So we have given on 31 3, 31 7. What is the date? 31 7 2007. 1 7 2007. You had got 10,000 units. On 31 3 2018, not 18, 2010. Okay. 2010. You had got 11,296.11. 11,296.11. That is what you had on 31/3/2010, and on 31st of March 2008 we just calculate the number of units purchased, that is 487.8. 487.8. So on 31st March 2009, what is the balancing figure is all what I'm asking. So 10,000 became 11,296. 487.8 was purchased on 2008. How much on 2009? This is the balancing figure. So 11,296.11 minus 10,000 minus 487.8, that is 808.31. I hope now you understood how this 808.31 is calculated in a smaller and in a smarter manner. So we'll go back. What is the purpose of this reinvestment? This is the number of units which is reinvested. What is the amount of reinvestment? Amount of reinvestment, nothing but dividend received. How many units you are having on this date? 10,487.80. This is the number of units you are having. And what is dividend per unit on this date? We have identified dividend per unit 20%, 2 rupees. So multiplied by 2 rupees. So what will be the amount of dividend reinvestments? 10,487.8 into 2, 20,975.6. We have got the amount of reinvestment. We have got the number of units received. So you can calculate NAV at the time of reinvestment on 31/3/2009. 20,975.6 divided by 808.31. 25.95, I think. 25.95. So this problem might be little complicated, but repeated questions have been asked of this variety. So after this, redo this problem as many times as possible. You'll get the structure clearly. It requires some practice. Okay, so let's go for 31/3/2020, 31/3/2010. A very simple process actually, because they given again annualized yield. His annualized yield is 73.52%. So what is the amount of investment? Amount of investment, I mean, whatever the investment value, I just directly write investment value at the end. 1 lakh you invest. On 1 lakh, you are getting how much returns? 73.52 annualized percentage. Annualized or holding period? Oh, annualized. Oh, this itself is annualized means you have to multiply the number of years also. So 1 lakh into 73.52%. This is for how many years? From 1/7/2007 to 31st March 2010. So if I say 2 years and 9 months, right? 2 years, 9 months. 2 years, 9 months means how many months? 24 plus 9, 33 months. 33 by 12. Remember, it's 14/7/2007, not the beginning of the year. So don't round it off to 3. So 33 by 12. So if I calculate 1 lakh into 73.52% into 33 by 12. 2,02,180 plus 1 lakh, 3,02,180. 302,180. And on this date, I have not received any dividend, so nothing to subtract. On this date, I have not received. Minus, divided by number of units. 11,296.11. Divided by 11,296.11. 26.75. So NAV on 31/3/10, 26.75. Okay, previous slide. I'll do it. Okay. I'll just summarize what and all happened in this problem overall basis. Let's see if you're able to understand on an overall basis. I hope you have taken down till here everything. Okay, let me tell you now. So what and all we had? 1/7/2007. This is the date of investment. And date of redemption 31/3/2010. Two dates they have given in between this. One is 31/3/2008 and another one 31/3/2009. Okay, from 1/7/2007 to 31/3/2008, they have given the annualized yield. How much was annualized yield? They have given 153.33%. 153.33% per annum. Clear? Per annum. Then from 1/7/2007 to 31/3/2010 for full period, they have given 73.52%. Yeah, 73.52%. They have given that number of units was 10,000 on these dates and 11,296.11 on this date. It's fine. Then what we calculated in investment amount. Investment amount was 1 lakh. Then using this 1 lakh and 153.33 percentage per annum, I have got investment value on 31/3/2008. How did I get? On 1 lakh, I applied 153.33% into 9 by 12, of course. How much value you had got? Remember, investment value had got on 1 lakh, return obtained, that is 153.33% in 9 by 12. I got investment value at the end as 2,14,998. 2,14,998. This is the investment value we got. Now on 31/3/2010, I did the similar approach. And on what percentage I applied? On 1 lakh, I applied 73.52% into 33 months by 12. Just like 9 by 12 I calculated, here I did into 33 by 12, which is what we just got, 3,02,180. 2,49,988. Similarly, here got 3,02,180. 2,49,988, 3,02,180. This is the investment value on 31/3/2010. This I divided by number of units. For that, what I've done? One adjustment I've done. On 31/3/2008, I subtracted dividend because NAV is before dividend, and that is why I subtracted dividend of 10,000. Dividend received on that date. But on 31/3/2010, did I receive any dividends? Nothing. On that day, I have not received any dividend. Therefore, net amount attributable to NAV investment 2,14,998, and here it was 3,02,180. I divided by number of units. So 2,14,988 divided by 10,000, 3,02,180 divided by 11,296.11, and that is how 2,04,000, sorry, yeah, 2,04,988 by 10,000, 3,02,180 by 11,296. That's how we got NAV as this was I think 20.5, and last NAV we got 26.75. Okay, and how did we compute NAV on 31/3/2008? With the help of dividend reinvestment. As a balancing figure, we compute the number of units on this day. 31/3/2009. What number of units? What we have got on this day? Number of units divided by the amount of reinvestment. I mean the dividend received and number of units. Using that, we calculated 31/3/2009. Okay, you want the previous slide? You can do the previous slide. So go to the problem once more and see if you are able to understand. Any calculation, if you have any doubt, you can ask. So this is the previous slide. And back to the summary part. Hope the summary makes sense. It's fine. Okay, let's go further. This is also a reverse problem, but different one, slightly different one. During the year 2017, an investor invested in a mutual fund. The capital gain and dividend for the year was 3 per unit. Distribution, which were reinvested at the end of the year, NAV was 23.75. NAV at the end given. Investor had a total units of 26,750 at the end of the year. NAV was appreciated by 18.75% during the year, and the entry load was 0.05 at the time when investment was made. Investor lost his records and wants to find out amount of investment made and the entry load in the mutual fund. This is practically impossible situation. He don't know how much investment he made, it seems. Very simple. Take the bank statement, you get the answer. How much investment you made. But examination, you don't do that. So this kind of things can happen in exam. But more importantly, uh, more than practicality of this aspect, the intention is to make you think in different angles. Reverse calculation is what objective of this problem. Okay. So here, what and all data we have, let's try to understand. During the year 2017, okay, 2017, I don't know, beginning end, let's say at the time of investment, investment, and let's say year end or something. I don't know the period. Capital gain distributed 3, which were reinvested at the end of the year, at the year end, NAV 23.75. Okay, NAV 23.75 per unit. Dividend received, dividend capital gain receipts, 23 per unit, 3 per unit, which was reinvested. Investor had a total units of 2650 at the end of the year. Okay, number of units 26,750. NAV appreciated by 18.75% during the year. So if I say what is NAV at the beginning, this appreciated. This appreciated by 18.75%. Holding period return, you can say. It is increased by 18.75%. Entry load of 0.05. Okay, entry load will take it later. Okay, now, since we know NAV at the end, can we calculate NAV at the beginning? Appreciate by 18.75% means what? If I start with 100 rupees at the beginning, it becomes 118.75 percentage terms. NAV is given as 23.75. You can cross multiply, I mean, you can do proportionate calculation. What is NAV at the beginning? Cross multiply 100 into 23.75 divided by 118.75. 100 into 23.75 divided by 118.75. NAV at the beginning. 20 rupees, right? 20 rupees. So this is NAV at the beginning. This 20 rupees is the NAV at the beginning. Okay. Now we have to solve one small equations. I don't know any alternative method. That is this. How many units we had? How many units we have at the end? Okay. So number of units at the beginning, I don't know. I will take it as X. Number of units, I don't know. I will take it as X. Now, how much amount capital gain? Okay. How much units have been reinvested? And that will give you the number of units at the end. How many units have been reinvested? The investor total capital gain and dividend for the year was 3 per unit. Okay. How many units we were there? We don't know. Now, can you tell me first of all? Understanding, right? Number of units at the beginning is X plus dividend received on reinvestment is total number of units, which is at the end. Now, how many units you have received? 3 rupee per unit. But 3 rupee per unit, but how much amount? 3 rupee. Can I say 3 into X? X number of units into 3 rupees? 3X is the amount invested. But I need number of units. So what is the formula? How do you calculate number of units? Amount divided by NAV. What is NAV? It is invested. The NAV was 23.75. They have given that reinvestment at the time of when the NAV is 23.75. So divide by 23.75. So how the equation will look like? X equals, so X plus 3X by 23.75 equals 26,750. You have to simplify. So cross multiply 23.75 into X becomes 23.x 23.75x plus 3x divided by 23.75 equals 26,750. So cross multiply 23.75 plus 3, that is 26.75x 26,750 into 23.75, 635, 312. So simplify x equal to this divided by 26.75, 23,750 units. Hope you got it, 30,750 units. So this is the number of units that you had at the beginning, and you got some more units. It is at the end. And NAV at the beginning, do we know? Yeah, NAV at the beginning we calculated 20 rupees. And number of units at the beginning we calculated. So you know the amount of investment. But one more thing is there that is called as entry load. I'll tell you what is the entry load also. First you write down till here. Let me know if you have any doubt. Okay. Let me explain the entry load concept. Very simple. That is like a purchase commission. So when you invest in mutual funds, as a commission, brokerage, you can say in a way, mutual fund will charge something. So your NAV is 20 rupees. So you are not only going to pay 20 rupees, you also going to pay commission to the mutual fund. So what is your total cost becomes? Your NAV is your price plus whatever commission you pay. That becomes your total outflow. So what is the amount of investments? I'm writing at the left extreme. Hope you're able to see. Amount of investment. Number of units is how much? We just calculated. 23,750 multiplied by what is NAV? NAV was 20 rupees. But you're not only paying NAV, you're also paying entry load, like a purchase commission. That is 0.05. So you add 0.05. Similarly, there is also concept of exit load. So when you withdraw money, enter 20 will not come to you. They will deduct something like a brokerage. You know, right? When you buy shares, share price plus brokerage you have to pay. When you sell shares, sale value minus brokerage will come to you. Like that concept. That's entry load, exit load. So 23,750 into 20.05, 4,76,187.5. 4,76,187.5. That is your total in amount of investment. 4,76,187.5. Okay, so that's all about this problem. Not very complicated. That equation is what you have to be careful. You can do without equation also, but this is fine. Okay, let's go further. Okay, let's go further. Okay, hope you got this question. This one is very similar. You would have seen this kind of problem earlier, but this is a different problem. Sir, I've seen, sir, dividend plan we have seen, bonus plan I've seen. Okay, we'll read the problem once. Mrs. Corpus on AMC on 1/4/2015 has floated two schemes, dividend plan, bonus plan. Mr. X investor invested in both the schemes. Very good. The following details, except the issue price, are available. Date, dividend, bonus ratio, NAV. Additional details, investment, rupees 9 lakh 20, 10 lakh, average profit, rupees, average yield. You're required to calculate the issue price of both the schemes on 1/4/2015. Do you understand what is the specialty about this problem? Again, reverse calculation. This normal problem we have done. Dividend plan, bonus plan, number of units, total units, value of investment at the end, minus value of investment at the beginning, divided by investment into 100. All these things we have done, right? But here, what is the requirement? You have to calculate the issue price. How many number of units you have applied, only not given. Number of units you have received the beginning, only not given. So when you look at the problem, be very careful in exam. It seems similar, but might be reverse calculation like this. So mutual fund is very simple chapter. That's why they try to complicate like this. Anyway, read the problem once more. November 2020 question. Okay. Let's focus on dividend plan. Hope you have read it. The question. Let's do first dividend plan. Again, reverse calculation. First, remember the normal heading we used to write? We used to write like date, dividend receipt, then dividend reinvestment, then number of units, right? That is number of units, then total number of units. Hope you remember the head column headings. Total number of units. Hope you remember the column headings. What are the dates on which dividend is received? 31/3/2017. 31/3/2017. Of course, initial also 1/4/2015. Then 31/3/17, 31/3/18. Then 31/3/19. Year end also. Year end will be 31/3/2020. Okay, that is last date. Okay, this is 1/4/15 is your initial investment. 31/3/20 is the ultimate last year. That is 5-year term, of course. So what we are going to do now? We are going to calculate in a reverse manner. We used to calculate, right, number of units into NAV on this date, total investment at the end, minus investment at the beginning, divide by whatever investment at the beginning into 100. We used to calculate. Here what we are going to do, please observe. What information we have regarding dividend plan? Amount of investment 9,20,000. Average profits means per year. So what is the investment value at the end? Okay, investment value at the beginning I know. Beginning value is 9,20,000. Beginning 9,20,000. Okay, that you write at the top for your reference. But investment value at the end, can I say like this? 9,20,000 is you invested, plus you got a profit of how much? Average profit 27,748.6. 27. Okay, 27. 748.6 for 5 years, 2015 to 2020, for a period of 5 years. 1,38,000 plus 9,20,000. So 10,58,743. 10,58,743. Please see if you are able to get that number. 10,58,743. And NAV on this date we know 49 divided by NAV 49. So divide by 49, you will get number of units. How much number of units at the end? 10,58,743 divided by 49. 21,607, right? 21,607. Okay. So on 31/3/2017, the end value is 21,607. And you calculate in a reverse manner and come out the beginning how many units were there. Investment at the end, divided by NAV, you get number of units. Okay, let's see what happened on 31st March 2019. You received a dividend of 15%. Face value at least have they given? Face value not given. When face value not given, we have to make an assumption, I think. Right? No face value given. I think we'll make an assumption of 10 rupees. Without that, we can't do anything. Or have they given somewhere just to confirm without before assumption? Bonus plan, investment plan, average yield. I think they have not given. Let's assume. Okay, let's assume. So write somewhere, assume face value as 10. Face value as 10. Percentage 12 or 15%. So that means 1.5 per unit. This will be 1.5 per unit. But how many units? Do we know number of units? We don't know. Don't take 21607. 21607 is after reinvestment. We should multiply before reinvestment. Okay, what information else is there? On 31 to 19, we have NAV. How much NAV we had? NAV of dividend plan 45. How do you calculate this? NAV for the year 2019. I've written that, no? NAV for the year 2019, 45. 45 only, no? 45. 31 2020 is 49. How can I take 49 for 2019? I cannot, right? So I should only take 45. 49 only I've taken, right? 49. 49 only I've taken. 49 I've taken for the date on 31 2020. But when it comes to 31 2019, I should take NAV of 45. This is the date on which you have reinvested. How do you calculate here? Just give me 1 second. 21607 into 45. Just give me 1 second. I know the process. I'm just thinking. I know the process. I'm just thinking whether I can simplify it a little bit. Okay, I'm just thinking whether I can do a little bit differently. Okay, let me just give the x basis. I know using x. I know. I was thinking whether we can do something without x. Let me just do it then. So if you assume x as number of units, what we had at the previously, x, if you had number of units into 1.5 will be the number of units, will be the dividend received, 1.5 per dividend, divided by 45. This will be the number of units received plus existing unit, which is x, which is equal to 21,607. I think this is the one. I mean, we have to solve like this. I think let's solve like this only. I'm not able to think anything other method. I have to put some more thoughts maybe. But using this method only, we'll solve it. I'll explain this once more. So if you have x units before, you will receive dividend of 1.5. So x into 1.5. So how many units you would have received? X into 1.5 divided by 45. That should be equal to 21,607. So let's simplify, cross multiply. So this is 1.5x. This is 45 into x is 45x. Then 21,607 into 45. 9,72,315. If I simplify, x equals, this is divided by 46.5, I think. 20,910. So number of units that you should have received by dividend reinvestment difference. Reinvestment 21,607 minus 20,910. 697. Hope you got it. 697. So dividend reinvestment 697. You can take down this X calculation. There must be better method, but anyway, I think X, I hope you are comfortable in understanding it. And before that we had 20,910. So before this we had 20,910. Let me follow same process again for the previous date. What is the dividend we have received on this date? 10%. This would be 1 per unit, and previous one is 12 per unit. Let me just write it, 12 per unit, and NAV is 50. Okay, so X into 1 divided by 50 plus X equals previous X, that is 20,910. I hope you will be able to simplify directly. X equals 20,910 into 50 divided by 50 plus 1, 51, 20,500. So reinvestment becomes 20,910 minus 20,500, 410. So going back, this is 410. Then 1.2 per unit, and NAV is 48. Okay. X into 1.2 divided by 48 plus X equals to the new in number of units, 20,500. So if I simplify for X, 20,500 into 48 divided by 49.2, 20,000. So reinvestment must be 500 difference. So reinvestment must be 500, and this is 20,000. 29, 2910, 2500. 2500. So issue time, initial time, number of units what you had would be 2500 minus 500, 20,000. I think you get the answer as 20,000. Please confirm if your calculation is fine. Okay. So what will be the issue price? 20,000, 9,20,000 is the amount. So issue price, I'm writing at the top. Issue price 9,20,000 divided by 20,000 units. 46. 46. Okay, this is dividend plan. A bonus plan should not be complicated. It's much more simpler than this. The ratio will reverse, that's all. So much more simpler. So I'll go for the bonus plan. So what format we used to do? Date, bonus units, then total units. Dates starting from 1/4/15. What are the bonus? Only two ratios are there. So 31/12/16 and 31/12/18. 31/12/16, 31/12/18, And year end, I mean last year, that is 31,320. And what is the investment you have done at the beginning or investment value at the end? You made an investment of 10 lakh, and average yield means annualized yield 6.4. So on 10 lakhs, you apply 6.4% for a period of 5 years and then add 10 lakhs. So 10 lakhs into 6.4% into 5 years plus 10 lakhs. 13 lakh 20,000. NAV on this date, NAV at end. Last NAV was 44. So number of units 13 lakh 20 by 44. 30,000 units. So on 31/3/2020, we had 20, or this is the year end. This was the beginning. So 31/3/2018, we are having 30,000 units. What is the bonus ratios? 1:4, 1:5. This is very easy to calculate because you know, right? If you have 5 shares, you get one bonus shares. That means total you will have 6. So directly I can do here 30,000 represents 6. How much for 1? Into 1/6 only you get. Very simple. 1/5 don't do it, 1/6 you do it. Because one share bonus, one bonus and 5 existing, total 6. So 1/6. So 30,000 into 6, I think 5,000. So previously would be 25,000. And don't do into 1/4, you do 1/5. 25,000 into 1/5. NAV does not matter here. That is 5,000. So total number of units at the beginning would be 20,000. Issue price amount, 10 lakh divided by 20,000. Issue price 1 lakh divided by 20,000, 5 rupees. 5 rupees, huh? Sorry. That's all. Please check, is the calculation correct? Sorry, 10 lakh. Oh, 10 lakh. So 50 rupees. 50 rupees. Okay, okay. Not 1 lakh, 10 lakh. So 10 lakh by 20,000, 50 rupees. 50 rupees. Okay. Let's go further. Next question. The following are the details of 3 mutual funds: MFN, average return, variance, coefficient determination. Remember, what is coefficient determination? This is R square. Variance, sigma square. The yield on 180 days treasury bill is 9% per annum. So this is a risk-free rate, RF. Rank the funds as per sharp measure. Rank the funds as per trainer measure. Compare the performance with the market. Sharp pressure means we require standard deviation. We can easily calculate. A trainer measure means we require beta, which you can calculate. So let's write down the solution in a columnar format. It's not going to be a complicated one. A growth fund, balance fund, regular fund. Growth fund, balanced fund, regular fund. I need standard deviation to compute the Sharpe ratio. They have given variance. So let me calculate square root of that. So square root of 92.16, 9.6. 9.6. Balanced funds 54.76, square roots 7.4, and regular fund 40.96, square root 6.4. Okay, this is standard deviation of, let's say, individual portfolio or security. Then let's calculate Sharpe ratio. Okay, you want the previous problems working? I'll do it after this. I'll show it to you. Sharpe ratio is given by portfolio return minus risk-free rate divided by standard deviation of portfolio. Then we can rank them. Portfolio return, this 765. 765. Then risk-free rate 9% everywhere. Minus 9, minus 9, minus 9. Divided by standard deviation 9.6, 7.4, 6.4. I think you get negative numbers everywhere. 7 minus 9 divided by 9.6 minus 0.21. Then this is minus 3 by 7.4, minus 0.41. Then 4 by 6.4, minus 0.625. Okay, so rank them, highest the better, but negative number, so be careful. Highest the better. Highest among all are negative, all are worst, but among them the best rank would be growth fund, 1 rank, because in negative they are less. Second is balance funds, little bit better, and little bit worse, and worst fund, regular fund, 3. Okay, anyway, uh, they've asked the Sharpe ratio we have done. Let's calculate trainer ratio. For trainer ratio, we need beta. We need beta of portfolio. Beta of portfolio we can calculate by R into standard deviation of portfolio or security divided by standard deviation of market. Standard deviation we know all these things, but R not available. But R square is there. R square is given. So we can calculate R. Maybe you can write here. So some working note you can do it below that. Or I'll do one thing. Here only I'll do a square root of it. I hope you're able to understand. They have given coefficient of determination 0.3025. So what I'll do square root of 0.3025. Hope you understand. Coefficient of determination is R square. If it is square root of that, I get R. Multiplied by standard deviation of portfolio here 9.6 divided by standard deviation of market. Market variance given, take a square root, 57.76 square root. So that will give you 0.3025 square root into 9.6 divided by 57.76 square root. I think 7.6. So how much you get? 1 point something. Point 3025 square root into 9.6 divided by 57.76 square root equals, okay, 0.6947. Okay, 0.695. That's 0.695. Similarly here, this square root correlation coefficient changes 0.6561. 0.6561 square root multiplied by 7.4 divided by same thing, square root of 57.76. Point 78868, 0.789. Then this codetermination 0.9604 into 6.4 is the standard deviation. Market 57.76 square root. 0.904 into 6.4 of 0.904 square root. 9604 square root into 6.4 divided by 57.76 square root. 0.825. 0.825. Okay, let's calculate trainer ratio formula. Trainer ratio. It is RP minus RF. Numerator is same. Denominator is beta. So numerator is same. 7 minus 9. By beta, what we just calculated, 0.695. 6 minus 9 by 0.789. 5 minus 9 by 0.825. I think everything you get negative again. 7 minus 9 divided by 0.695 minus 2.89. 3 by 0.789 minus 3.8. 4 by 0.825 minus 4.85. I think here also rank is same. No, rank is slightly similar order. Ranking is similar order. All the three are worst. Relatively better. First is growth. Second minus 3.8 you got. So second. And third minus 4.85 worst. So 1, 2, 3. I think ranks are same. 1, 2, 3, 1, 2, 3. Easy to calculate. Okay. Last thing they're asking. Compare it with the markets. I'll just write it here, one more column for market so that I can calculate. Okay, market standard deviation 57.76 square. 7.6. So when I calculate here, what is market return? I think 9% is market return. So 9 minus 9 by 7.6. I think you get 0. It need not be always 0. Okay, it happened to be 0. And trainer ratio, beta anyway 1. Beta of market, we know it is 1. So 9 minus 9 divided by 1. This will also give it 0. I know it got 0, but at least this is better than 3 funds, because 3 funds have got negative, which is bad. Market at least has got 0. 0 is better than negative. So you can write one line comment. Market is better than all the three funds. Market is better than all the three funds. Market is better than all the three funds. Okay, hope you are done. Let's go further. Okay, fine. Sorry. Hope you got the question. It was asked in January 21 for 8 marks. Hope you got it. Okay. On January 2020, an open-ended scheme mutual fund had an outstanding units of 300 lakhs with NAV of 20.25. At the end of January 2020, it issued 5 lakh units. Beginning 300 lakhs units was there. Additionally, they have issued. And opening NAV plus a load of 2%. Opening NAV, I think that V is not shown. Opening NAV plus a load of 2%. Adjusted for dividend equalization. Oh, this is one slightly different concept. I explained when solving problem. Dividend equalization. At the end of the year 2020, it had repurchased 2.5 lakh units at an opening NAV less 2% exit, adjusted for dividend equalization. At the end of the year 2020, it had distributed 70% of available income in respect of January to March quarter. Following additional information is available. Value of appreciation of the portfolio 460 lakhs. Income for Jan, income for Feb, income for March. You require to calculate income available for distribution, issue price at the end of January, repurchase price at the end of February, closing value of net assets at the end of what? Oh, okay. I'm not at the end of next page. Sorry, at the end of March. That's all. No. Okay. At the end of March. Okay. At the end of March. Fine. Okay. One concept is there. Dividend equalization. Very simple concept. Try to be with me and see if you're able to understand. I will give an example of bond. Let's say Mr. X is bondholder from 1/4/2019 for a period of, let's say, 2 months. That is till 1/6/2019. He has transferred it to Y on 1/6/2019. Now, on 30th of June 2019, let's say company pay coupon. Company pay coupon. Let's say they pay coupon of 3,000 rupees at whatever percentage. Now you tell me, Mr. Y will receive full 3,000 or will he receive proportionately for uh, 1 month held? What do you think? How much Mr. Y will receive? He will receive full, not proportionate. Company will not do investigation. When a person purchase basics or intermediate, he will receive full 3,000. But is it justified? How come? Why? Just having holding period of 1 month, but getting full 3 months income 3,000? How do you think it is justified? Justification happens because when X transferred to Y, the Y would have paid the 2,000 rupees also. Let's say 1,000 per month is accrued. He would have paid 2,000 rupees. And now he'll receive 3,000. Effectively, 1,000 income is achieved. Hope you understood the concept. When a person becomes the investor during the year, when a person becomes investor during the year, whatever income accrued till date, he has to pay for it. Apart from the value of asset as on that day, value of bond, you also should pay income accrued till date. Do you understand the concept? That is what is dividend equalization fund is all about. Simple concept. There are some unit holders at the beginning of the year. No problem with them. Some unit holder joins. So when you join in middle of the year, you pay not only for the NAV, you also pay for the income accrued till date. At the end of the year, when they pay the back dividend to you, that will be recovered. But when you pay, you have to pay NAV also, like the value of the bond and income accrued till date to make it equivalent with the other investors. That's a concept. So you can just uh, write down one or two sentences, not much. Dividend equalization. Dividend equalization. Heading you write dividend equalization. Below that you write down when an investor when an investor when an investor invest during the year, when investor invest during the year, when investor invest during the year, investor during the year, the issue price or investment price will be the issue price will be the issue price will be NAV and the issue price will be NAV and issue price will be NAV and income accrued till date. Issue price will be NAV and income accrued till date. Income accrued till date. Income accrued till date. Full stop. Next sentence. Similarly, if investor redeem during the year, if investor redeem during the year, investor redeem during the year, the redemption price will be NAV. Redemption price will be NAV and redemption price will be NAV and income accrued till date. Redemption price will be NAV and income accrued till date. Income accrued till date. Did you get the concept? If you become an investor, you pay NAV and you also pay for dividend equalization. But when you withdraw money, you get NAV also, you get income accrued till date also. So you pay NAV, you pay dividend equalization. When you withdraw, you receive NAV, you receive dividend equalization. Beyond that, don't break your head on dividend equalization. Simple concept, NAV plus dividend equalization, NAV plus dividend equalization. In both cases, that number should be added. Simple concept. Okay, so let's down now calculate income available for distribution. Considering this this dividend equalization is what we have to calculate. Let's do it in a columnar format. Okay, so give the heading income available for distribution. Income available for distribution. Okay, let's write number of units, then per units, then total value. Okay, income for January. Every month we have to calculate income for January. How much income for January? We have 24 lakhs. 24 lakhs. Rupee, everything in lakhs. How many number of units we had at the beginning? 300 lakhs. So what will be per unit? 24 divided by 300. 4 decimals, you tell me. 0.08. Okay, 2 decimals only will get. Okay, 0.08. Straightforward. So in the month of January, every unit has earned 0.08. Income accrued in January, we can say. If somebody comes in February, they will pay for NAV also, they pay for 0.08 also. Hope you got it. Okay. Now, at the end of January 2020, it had issued 5 lakh units. So these 5 lakh units people would have paid NAV for sure. That will keep it aside. Apart from NAV, they'll pay for dividend equalization. How much? 0.08 what we just calculated. So units issued in January end. Units issued Jan end and income collected. Dividend equalization collected. Dividend equalization collected. How much they have collected now? 0.08 per units. 5 lakh units. So 5 into 0.08, I think 0.4. So at the end, you are having 305 units and value what is available 24.4. Hope you understood now. 24.4 is the income available for distribution with the fund. How it is available? 24 you have earned it. 0.4 you have collected it. So totally 24.4. Now does it make sense to you? Do one thing now. You calculate 24.4 divided by 305. Just notional basis. Don't calculate. Don't write it. Notional basis. You please tell me. 24.4 I have. Total. 305 units are there. So if I divide by it, what will happen? 24.4 divided by 305. I get 0.08 only, right? 0.08. Now, what is the impact on 300 lakhs people, existing holders? They earned 0.08, they get 0.08, justified. What about the new people who are at? They have paid 0.08. If the company distributes, they will get 0.08. As a result, their impact will be same. You understood why this amount is being collected? So basically, 300 lakh units, they have earned 0.08. Using their money, we have earned. And these 5 lakh units people, they will pay me 0.08. So ultimately, when I'm distributing, I'll give back both. So that will be maintained. Hope you understood the concept of dividend equalization. Okay, this is for the month of January. Let's come for month of February. Same process. Income for February. Only thing you should do is see 300 plus 5, 305. 24 plus 0.4, 24.4. Don't do 0.08 plus 0.08 is 0.16. That is an average. So don't add average. That you keep it in mind. Just because in table format, don't simply add it. So income for February, how many units we are having now? 305 units, right? We are having 305 units. Okay. And how much income we have earned? Income for February, we have earned 36 lakhs. Income we have earned 36 lakhs. So let me do one subtotal now. So value will become this 36 plus 24.4, right? You hope you understand. 36 plus 24.4. Because we are already having 24.4. And we are earning additionally 36. That is 60.4. So what is going to be per unit? 60.4 divided by 305. 0.1980, is it? Okay. So 0.1980. This is the cumulative income, not earned in February, earned till February. Cumulative. January also, February also together. Fine. So units redeemed. I think in the month of in the month of February, you have redeemed, right? At the end of February 10, you have repurchased, means redeemed. So units redeemed, and therefore dividend equalization you pay to them. When you issue, you collect. Now they are selling, so they have to get the money. Units redeemed and dividend equalization paid. Paid. Outflow, negative. So this will be negative. This will be negative. This also will be negative. So how much will be there? How many units? Repurchase 2.5 lakh units. So 2.5 lakh units are redeemed. Per unit is going to be 0.1980. 1980 into 2.5. From mutual fund point of view, you pay it up. It goes up. 0.495. So you will get at the end 302.5. And here 60.4 minus 0.495. 59.905. This 0.198, 0.98 don't do minus. Like I told you previously, it's an average. So don't do minus. It will remain as 0.198. You can calculate 59.905 divided by 302.5. You get that number. 0.198. Okay. So January over, February over. Let's do March. Income for March. I think March, there is no issue or there is no equalization, just the income portion. 47 lakhs. And portion cumulative, okay? So 59.905 plus 47. 59.905 plus 47. 106.905. 106.905. I think we are having 302.5 units only. No redemption happened. So 106.905 by 302.5. 0.3534, right? 0.3534. Okay, fine. 0.3534. Cumulative 0.3534. Then At the end of March 2020, that is after this, March is over, right? March is over. At the end of March 2020, you have distributed 70% of available income. What is available income? We calculated. This is available income. You pay out dividend paid 70% of available income. So 70% of this is paid out. A number of units will not change. Number of units will remain same, but per unit will change. Value will change. Number of units will be say 302.5. 70% is paid out. I mean, don't write this one blank. 0.3534 70%. 0.3534 70%. 0.2474. 0.2474 multiplied by 302.5. 74.8324. So this is paid out. So subtract. So the remaining, whatever the remaining income available, like reserves and surplus, this is 302.5 will remain. 0.3534 minus 0.2474, 0.106, 32.065. I think approximately you get that number, 32.065. 70% is paid out, so remaining that remains. Okay, hope you got it. This is first part of the question. Income available for distribution. They are asked only income available. So you could have stopped at this point also. Income for March, I could have stopped at it, but we have gone one step further for the remaining amount after dividend paid. Okay, hope it is done. I'll go for second part. Issue price at the end of January. Issue price will be what? NAV. You should consider dividend equalization. I told you, you will add. What about the entry load, exit load? What will happen to that? Now, as I told you, if you think from investor point of view, when you enter, you will pay NAV also, you will pay entry load also, like a commission. So what will be effective cost? NAV also you pay, entry load also you pay. But when you withdraw, you get NAV, but you have to pay commission. So NAV minus exit load. So if you want to calculate, they're asking issue price at the end of January. Okay, issue price is calculated as NAV plus entry load plus dividend equalization. Hope you understand. Whereas redemption price or repurchase price, both are the same. Redemption price is NAV not plus entry load minus exit load, like a sales commission. Exit load. Dividend equalization is added. Plus dividend equalization. So many people what they think is entry load they do plus and minus correct because opposite. But dividend equalization also they do opposite. They do plus and minus. That is wrong. Here also you add dividend equalization. Here also you add dividend equalization. So what is NAV given? 20.25 entry load in percentage terms. How much percentage? 2%. 2% of 20.25. How much that is going to be? 0.405. And dividend equalization that we calculated. How much dividend equalization which we collected? 0.08. Remember, we collected 0.08. That much has to be paid by investor. So 20.25 plus 0.405 plus 0.08. 20.735, I think. Okay. Similarly, redemption price, NAV 20.25 minus exit load. Exit load is 2%. 2% on 20.25 plus dividend equalization. How much dividend equalization? Dividend equalization paid. Dividend equalization paid 0.1980. That you don't subtract. That is payment for the mutual fund, receipt for the holder. So 20.25 minus 2%. How much 2%? 0.02. 0.405. Okay, same number you get. 20.25 minus 0.405 plus 0.198. 20.043. Okay, fine. Let's go further. Last part of the question. Closing NAV of net asset at the end of March. So NAV calculation, you know how to do it. Value of all the assets minus liabilities divided by number of units. So value of all the assets. What was asset at the beginning? Then we are going to add all the income received. And then we are going to add any money received by issue of units, subtract any dividend paid, subtract any redemption. That will give you the cash balance, net asset balance, divided by number of units will give you the NAV. Income for March, slide calculation. Okay, income for March, this is the calculation. Okay, fine. Let's calculate NAV at the end of March. Last part of it. NAV at the end of March. So what and all we are going to use it here? Very simple process. We'll start with January opening assets in January. Then whatever income we have earned, income is going to be added in Jan, in Feb, in March, and then portfolio appreciation, unrealized income, that also is going to be there. Portfolio appreciation Okay. Then inflow outflow. What is inflow? Issue of units. You will have inflow, that is issue of units. Then you will have outflow. What is outflow? Two outflows are there. One is this inflow. Outflow, two in outflow. One is redemption, and the other is what? Dividend payment. Dividend paid. Then whatever we divide by number of units, you get NAV. Okay. So what are the amounts? Let's write it down. January income 24, 36, 47. 24, 36, 47 rupees, everything lakhs. And what was opening assets? Opening assets, opening NAV you can take. That is 300 lakhs units, 20.25. 300 into 20.25. Opening assets. 6075. 24, 36, 47. Okay, portfolio appreciation 406, I think. Issue of units. How many issue price we calculated? 20.735. Includes equalization, everything. 20.735 multiplied by how many units? 5 lakh units, I think. 20.735 into 5, 103.675. Redemption of units. What is issue price? Redemption price 20.043. 20.043 multiplied by 2.5, I think. That is outflow. So minus 50.1075. Dividend paid that we calculate already at the beginning, 73.8324, I think. 74.8324. Okay. 74.8324. 74.8324. It is outflow. So subtract it. Okay. So what is net asset of the fund? $6075 plus 24 plus 36 plus 47 plus 406 plus 103.675 plus 50.1075 plus 74.8324. 6816 something. Oh, sorry, 460 was the portfolio appreciation. Sorry, not 406. Portfolio appreciation is 460, not 406. 460. Yeah, I wrote 406. 460. I think 6870 something you get. See. 6075 plus 24 plus 36 plus 47 plus 460 plus 103.675 minus 50.1075 minus 74.8324. 6620 something, right? 6620.73. Okay. 6620.73. 734. 6620.734. Okay, 735. Divide by number of units. How many units we had? Beginning 300 we had. We issued 5. Oh, okay, we already know 302.5 number of units. Number of units 302.5. Calculate NAV per unit. 6620.735 divided by 302.5, 21.8867. Yeah, 21.8867. Okay, so this is about dividend equalization, NAV, entry load, exit load, everything given. Good. So that's it with the problems still here. Okay, this is one interesting problem, RTP problem. Let's do this. The following particulars relating to S fund schemes, investment in shares at cost. They used to give one value. Here they have given in pharmaceutical companies, in construction industries, in service sector companies, in IT companies, in real estate companies. Investment in bonds, fixed income, listed bonds, 8,000, 14% bonds of 15,000 each, unlisted bonds, number of units outstanding, expense payable, cash and cash equivalents, market expectations of listed bonds, 8.842%. Fund has incurred the following expenses: consultancy and management fees 520 lakhs, office expenses, advertisement expenses. Particulars relating to each sector are as follows: sector, index on purchase date, index on valuation date, required NAV of the fund, calculate NAV per unit, determine net annualized return if the period consideration is 4 years and the fund is distributed 2 per unit per year as cash dividend during the same periods. Uh, Calculate the figure in rupees crores up to 3 decimal points. Okay, very good. So normally, you know what we used to do, especially while doing value of investments, value of investment multiplied by current index divided by previous index at the time of purchase. Basically, that proportion we used to apply on investments. But here, instead of having one index, they are giving 4 index. In fact, 5 index. Why they have given 5 index? Because you are having 5 investment, right? So the same process we do, the value of investment multiplied by the current index divided by the historical index at the time of purchase. Basic interpretation, that is, we are assuming our portfolio movement is proportional to market movement. But here, not one market, we are having sector wise movement. Because we are investing sector wise, let's take sector wise index. Then we'll come to value of bonds and other aspects. Okay, so let's calculate one by one. First, net asset of the fund. Net assets of fund. Let's first take investment in shares. Investment in shares. We'll take one by one. So pharmaceutical companies 158. What has to multiply? I'll have to multiply it by the current index, that is 500, and divide by the previous index, that is 300. So it's going to 1 second. 1 second. So it's going to be, yes, 158 multiplied by, okay, also will write pharmaceutical companies. Pharma companies 158 into 500 by 300. So that is 263.33. They said take 3 decimals. 263.333 rupees crores. Construction companies 62 into 490 by 275. 110.473. Please confirm if the numbers are fine. Three decimals you have to take. Service sector companies 112 into 500 by 285. 196.491. Okay. Then we have IT companies 68 into 515 by 270. 129.704. Real estate companies 20 into 440 by 265. That is 33.208. Okay. If you want, you can do a subtotal of this. 733.209. Because I'm next I have to write in the next slide. I'm writing subtotal. Otherwise, subtotal not required. Okay. Next. Hope this is done. So we have done the valuation of investment in shares. That is done. Then value of investment in bonds. Value of investments in bonds. Normally, what used to happen? Bond value they used to give in the problem, or they used to give like it is to be valued at cost, or sometimes they used to give like uh, it is 96.5%, face value 100 means value is 96.5, or there is a diminution in the value by 15%. So we used to multiply it by 85%, things like that. But here they have not given. They have not given market expectation or something. So in those cases, what you should do? We have to value bonds. Valuation of bonds, going back to our bond valuation. That's why should always do bond valuation, equity share valuation, then come to mutual funds. Anyway, now can you please tell me what is the formula for value of bond? How do we use to calculate bonds? Coupon multiplied by annuity factor, redemption value multiplied by discounting factor. But here we don't know how many years to take, number of years not given. Then let's go for simple formula, that is perpetual bonds. So what is the value of bond? Formula we used to calculate value of the bonds is given by numerator is going to be cash flow or coupon, Numerator is coupon. Basically, that is annual cash flow. And denominator is required rate of return or expected return. Or you can say yield. I'll just expected yield. Expected return. Expected yield. That's the formula. Perpetuity formula. Cash flow by rate of return. CF by I. Or annuity by I. Cash flow by I. A perpetual bond cash flow formula. Okay, I'll explain this. Somebody wants the previous slide. Take it quickly. Okay. Now, regarding here, what is expected yield? That is very clear. In this problem, expected yield is 8.842%. Expected yield is 8.842%. Now, what is the numerator part? Cash flow, coupon. How much is coupon? Very simple, sir. 8,000 is the number of bonds. 15,000 each. That is 8,000 into 15 face value you get. On that 14%. That is coupon. So here you are interpreting it 14% as coupon. That is normal interpretation. I also agree with you. But what Institute has done, they have interpreted this 14% as yield. In the sense, the yield or the market yield, not the expectation, the present yield before the expectations or historical yield, what they were getting. So instead of applying it on face value, they have applied the 4% on the value in crore itself, market value, which I usually don't agree, but Institute has done like that. So I'll show you that. But anyway, let's write down both for your reference. So if you want to calculate coupon, it depends on information. That is, if you have face value, then you multiply it by coupon percentage. Then you will get the coupon amount. If you have market value, if you want to apply it on market value, then you should multiply it by the present yield, not the expected yield, the present yield or historical yield percentage. That will give you the coupon. So, what if you face value? How much is face value case of the bonds? 8,000 into 15,000. 8,000 into 15,000 into 14%. How much is the coupon amount coming to? 8,000 into 15,000 into 14%. 1 crore 68 lakhs. I'll say 1.68 crores. Okay. That means this 14% is assumed as coupon rate. Assumed as coupon rate. What Institute has assumed? They have assumed as yield. In that case, what do you do? Market value. What is market value? 24 crores multiplied by the present yield or cost. You can say cost also. Instead of market value, you can say cost. So for 24 into 14%. 3.36. 3.36 crores. So they have assumed this as yield. Assumed as yield. I hope you understand two different interpretations. First one is more logical in my opinion, but second one is not incorrect. But that's what Institute has given. Let's go with that approach. So what's going to be the value of the bonds? Based on Institute approach, coupon, that is 3.36 crores divided by the market expectation, that is 8.842 crores, future expectation, expected yield 8.842%. 3.36 by 0.08842. 38. I think 38 exactly you get. right? 38, 38, 38 you get. What about unlisted bonds? Unlisted for no information, I think. We'll take cost only. That is 14. Unlisted 14. Unlisted 14. So this total becomes 52 crores, right? 52 crores. Okay. Uh, Tell me this one. What should I do with respect to consultancy management fees, office expenses, advertisement expenses? So these things, should I add or should I subtract or should I ignore? That depends on your interpretation again regarding cash and cash equivalents. If you assume this cash and cash equivalent is at the opening balance, if you assume cash and cash equivalent is the opening balance, then these expenses should be subtracted. But if you assume these are the cash and cash equivalent as on a particular date, if these assume to be cash and cash balances as on a particular date, then you need not subtract, you need not add, you can ignore that information, correct? Hope you understand. Opening balance means expense paid during the year is subtracted. If it is closing balance, those expenses are already subtracted and then no need to subtract. But the question they just said cash and cash equivalent, they're not specified. So let's assume something. So let me just summarize this, whatever value we had. So investment in shares, 733.209. Investment in bonds, 52. Cash and cash equivalents, 3 crores. So assumed as closing balance, which is reasonable assumption because when nothing is specified, we assume the balance as on date. So assumed as balance as on date, not the opening balance. Assumed as balance as on date. So we are not subtracting here. Value of shares also beginning. No, value of the shares cannot be at the beginning. Uh, See, this is investment shares at cost, right? The question is very clearly given. Investment in shares at cost. So again, these informations are all at cost. Cash balance, when nothing is specified, it is not proper to take it at opening balance because lot of things you would have purchased, lot of things you would have sold, dividend you would have paid. So lot of adjustments takes place, right? You have some dividend information and all, which comes later. So if you want to do that, you should do every adjustment. I hope you understand. That was the point. But sometimes in some questions you would have seen, they will tell you cash and cash equivalent on 1st of April, something like this. So my recommendation, cash and cash equivalent, if they just tell you cash and bank balance, you take it as closing balance. If they're mentioned as 1st of April, then you take it as opening balance. Hope you got the point. Okay, so cash and cash equivalent is done. Less liabilities, expense payable. These are all rupees crores. Only one expense payable we have, 7 crores. This is this expense payable 7 crores. So net asset of the fund, first part of the question actually. 733.209 plus 52 plus 3 minus 7. 781.209. Again, it is crores. Second part of it, NAV per units. 781.209 crores divided by number of units. How many number of units are there? 8.4 crores. 8.4 crores. So you get crore get cancelled. Think you get exactly 93. This need not be three decimals. Rupees in crore only three decimals. I think this 93 is fine. 0.00 you get. Okay. Third part of I hope you have done. Let's just go to the last part of the question. Okay. Then what else they've asked? Last part of the question. Determine NAV annualized if period is considering of 4 years and fund is distributed 2 per unit per year as dividend during the same period. Calculate the figure in crore up to 3 decimal points. What is the beginning NAV? That not given, no? Oh, sorry. No, have they given how much he has invested? A person has invested. In the ending NAV we calculated. What is beginning NAV? Just 1 second. Okay, we don't have any other information. So what we have to calculate is okay. So what we have to do only is this. If you look at the problem, how much opening NAV is not given. So we'll assume these costs were there at the beginning also. These cost of investments were there at the beginning. At beginning also. In the sense, you have not purchased anything new and you have not sold anything new. You might have some more cash balance earlier, which I don't know. As I told you, cash and cash equivalent we already interpreted, assumed as closing cash balance. So let me not touch that. Expense payable, again, this liability as on date, let me not touch that. Because these two were cost, shares at cost, investment bonds at cost, I can also assume this was at the same cost at the time of purchase also, or value at the time of whatever period back. So based on that assumption, I'm doing historical NAV. Just 1 second. Okay. So historic in returns. First, let's write the formula quickly. Returns, P1 minus P0 plus D1 by P0 into 100. This formula, P0 historical. Let's calculate based on cost. Historical NAV based on cost. So take all the value of investment in shares and investment in bonds. What are the amounts you are going to get? cost wise only, like 158, 62, 112, 68, 20. Hope you're getting what I'm doing this. These are all cost of investments. I assume to be same cost back also, and 24 and 14 divided by number of units, that is 8.4. Can you tell me how much you get approximately? 2 units are decimals, two decimals are fine. 158 plus 62 plus 112 plus 68 plus 20 plus 24 plus 14 divided by 8.4. 54.52. Let's take two decimals. 54.52. So what is the holding period return? P1, what we just calculated, 93, I think, minus P0, that is 54.52. Any information on dividend distribution? Dividend, they said information. How much dividend? They said, I think, 2 rupee or 4 rupee something. 2 rupee per year. And they said it is for 4 years. So how much dividend you would have received? 2 rupee per year means 2 into 4. 8 rupees you would have received, right? Plus 2 rupee into 4. You would have received 8 rupees. Divided by P0, that is 54.52 into 100. This is holding period returns. 93 minus 55.42, 54.52 plus 8 divided by 54.52 into 100. 85.25%. Okay, but this is for 4 years, right? Holding period. This is for 4 years. They asked annualized yield. So divide by 4. Annualized yield or annualized returns. Annualized returns 85.25 multiplied by 1 by 4. This is for 4 year. How much for 1 year? Some 21.31% approximately. And as returns 21.31%. Okay, so that's it. Based on whatever information we had, we have calculated the numbers.